In 2008, millions of Americans thought owning a house was the safest bet in the world. Spoiler alert, it wasn't. Prices soared, banks freaked out, and suddenly everyone was losing their homes faster than I can rattle my bones. Let's dig into the chaos that made the financial world go kaboom. Hey there, I'm your skeletal guide to financial disasters. The 2008 housing crash demolished savings, crashed the global economy, and this story has everything: greed, delusion, and terrible math. Let's break it down. The setup: how the bubble formed. All right, let's rewind to the late 1990s and early 2000s. The dot-com bubble had just burst, the economy was shaky, and the Federal Reserve decided to do what central banks do best: lower interest rates to basically nothing. The idea was to stimulate the economy by making borrowing cheap. And boy, did people borrow. Suddenly, getting a mortgage was easier than getting a library card. Banks were handing out loans like Halloween candy, except this candy was laced with financial poison. Here's where things get spicy. Back in the day, if you wanted to buy a house, you needed a solid credit score, a decent down payment, and proof you could actually pay the thing back. You know, common sense stuff. But during the bubble years, banks threw all that out the window. They started offering what we call subprime mortgages. These were loans given to people with poor credit, little to no down payment, and sometimes no proof of income at all. Yes, you heard that right. Some mortgages were literally called ninja loans. No income, no job, no assets. I don't have muscles, and even I can see that's a terrible idea. But wait, it gets better. Or worse. Definitely worse. Banks weren't just giving out sketchy loans, they were packaging them up into fancy financial products called mortgage-backed securities and collateralized debt obligations. Think of it like this. Imagine taking 1,000 questionable loans, chopping them up, mixing them together, and selling pieces to investors while claiming they're perfectly safe. Credit rating agencies, whose job was to call out this nonsense, gave these toxic packages AAA ratings, the same rating as rock-solid government bonds. It was like calling a house of cards a fortress. The housing market went absolutely bonkers. Prices skyrocketed year after year. People bought homes they couldn't afford, thinking they could just flip them for profit in a few months. Real estate became the hot investment. Everyone from your dentist to your barista was buying property, convinced prices would rise forever. There's just one tiny problem with that theory. Nothing rises forever. Gravity exists both in physics and in economics. Meanwhile, the financial system was playing an even more dangerous game. Banks were so confident in this house of cards setup that they leveraged themselves to the moon. Some major institutions were operating with leverage ratios of 30 to 1 or higher. That means for every dollar they actually had, they were betting $30. When you're that exposed, even a small hiccup becomes catastrophic. And oh boy, was there a hiccup coming. The crash, when reality hit. So when did the music stop? Around 2006, housing prices started to plateau. Then in 2007, they began falling. Suddenly, all those adjustable rate mortgages that seemed like great deals started adjusting upward. People who could barely afford their initial payments definitely couldn't afford the new higher payments. Foreclosures began piling up. And remember those mortgage-backed securities that were supposedly safe? They started defaulting left and right. Investment banks that had gorged themselves on these toxic assets started choking. Bear Stearns collapsed in March 2008 and had to be rescued in a fire sale to J.P. Morgan Chase. But the real earthquake hit on September 15, 2008, when Lehman Brothers, one of the oldest and largest investment banks on Wall Street, filed for bankruptcy. It was the biggest bankruptcy in U.S. history at the time, and it sent shockwaves through the entire global financial system. Here's the thing about modern finance. Everything is connected. Banks lend to other banks. Investment firms buy from other investment firms. When one domino falls, it knocks down dozens more. Credit markets froze. Nobody trusted anybody. Banks stopped lending, businesses couldn't get credit, and the entire economy seized up like an engine without oil. The stock market went into free fall. The S&P 500 lost about half its value from peak to bottom. Retirement accounts evaporated. Jobs disappeared. It was a full-blown financial meltdown. The government had to step in with unprecedented bailouts. The Troubled Asset Relief Program, or TARP, pumped hundreds of billions of dollars into failing banks. The Federal Reserve slashed interest rates to near zero and started buying up assets to inject liquidity into the system. The Treasury Department orchestrated rescues of major institutions. It was the economic equivalent of emergency surgery, and even then, the patient almost didn't make it. For regular people, the crash was devastating. Between 2007 and 2010, around 6 million Americans lost their homes to foreclosure. Unemployment shot up to 10%. Millions of people saw their life savings vanish. Families that had been financially stable were suddenly struggling to put food on the table. Meanwhile, the bankers and executives who'd engineered this disaster often walked away with golden parachutes and minimal consequences. The whole thing reeked of injustice, and people were rightfully furious. The aftermath and consequences. The aftermath of the 2008 crash was brutal and long-lasting. The Great Recession, as it came to be known, was the worst economic downturn since the Great Depression. Global GDP shrank. International trade collapsed. Countries from Iceland to Greece faced financial crises. It took years for the economy to recover, and even then, the recovery was uneven. Wealth inequality grew wider. Many people never fully recovered what they lost. The crash exposed massive flaws in the financial system. Regulators had been asleep at the wheel. Credit rating agencies had been complicit in the fraud. Banks had prioritized short-term profits over long-term stability. The incentive structures were completely broken. Executives got massive bonuses for short-term profits with no accountability for long-term consequences. It was capitalism on the way up and socialism on the way down. Privatized gains, socialized losses. Chef's kiss of terrible policy. In response, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010. It created new regulatory oversight, established the Consumer Financial Protection Bureau, and imposed stricter capital requirements on banks. The rules aimed to prevent another meltdown by making banks hold more reserves and limiting risky behavior. Did it work? Well, we haven't had another crash of that magnitude, so partial credit. But some regulations have been rolled back over the years, and the financial system remains complex and interconnected. The potential for future problems never fully disappears. One fascinating consequence was the shift in how people viewed home ownership and investing. The cultural narrative that housing always goes up got shattered. An entire generation became more skeptical of Wall Street and big banks. Occupy Wall Street emerged as a protest movement. The political landscape shifted, with populist movements gaining traction on both the left and right. The crash didn't just hurt people's wallets, it fundamentally changed trust in institutions and shaped political discourse for over a decade. The lessons, what we should have learned. So let me break down the key takeaways, because apparently we need to spell this stuff out. Lesson 1. If something seems too good to be true, it absolutely is. When people with no income are getting $500,000 loans, that's not innovation, that's insanity. Lending standards exist for a reason. They're not fun red tape meant to ruin your day. They're guardrails preventing you from driving off a cliff. Lesson 2. Leverage is a double-edged sword. Borrowing to amplify gains works great when things go up, but it amplifies losses just as much when things go down. Financial institutions operating with 30-to-1 leverage ratios are disasters waiting to happen. It's like building a skyscraper on a foundation of toothpicks. Eventually, physics wins. Lesson 3. Complexity can hide risk. Those mortgage-backed securities and collateralized debt obligations were so complicated that even the people selling them didn't fully understand what was inside. When financial products become too complex to evaluate, that's a red flag the size of a football field. Simplicity and transparency aren't boring, they're essential for stability. And Lesson 4. Incentives matter enormously. When mortgage brokers got paid for originating loans regardless of quality, they originated terrible loans. When credit rating agencies got paid by the companies whose products they were rating, they gave inflated ratings. When executives got massive bonuses for short-term profits with no accountability for long-term consequences, they took reckless risks. If you want people to behave responsibly, structure the incentives to reward responsibility, not gambling. Lesson 5. Regulation and oversight aren't optional luxuries. Free markets are powerful engines of growth, but they need rules and referees. Without proper oversight, financial institutions will push boundaries, take excessive risks, and externalize the costs onto society. The 2008 crash proved that the cost of regulation is far less than the cost of financial collapse. And maybe the most important lesson, ordinary people shouldn't have to pay for the mistakes of Wall Street. The fact that bankers got bailed out while homeowners got foreclosed on left a bitter taste that still lingers. Any future policy response needs to prioritize protecting regular people, not just saving institutions. Moral hazard cuts both ways, and accountability matters. Closing. The 2008 housing crash was a preventable disaster born from greed, delusion, and systematic failure. It hurt millions of people, shook the global economy, and exposed deep problems in how we regulate finance. The scars are still visible today in policies, politics, and personal finances. But here's the thing about history. It tends to rhyme even if it doesn't repeat exactly. Housing prices have been climbing aggressively again in recent years. Some markets look stretched. People are taking on massive amounts of debt. Sound familiar? In our next video, we're going to compare the 2008 crash to the housing market warnings we're seeing in 2026. Are we heading for another disaster, or is this time actually different? Spoiler alert, I have opinions, and they're bone-chilling. If you learned something today or enjoyed watching a skeleton explain financial disasters, hit that like button and subscribe for more economics content with a side of sarcasm. Drop a comment and tell me what financial topic you want me to cover next. Until then, remember, diversify your portfolio, don't trust everything Wall Street tells you, and for the love of all things holy, read the fine print before signing anything. This has been your skeletal guide to avoiding financial ruin. Stay bony, stay smart, and I'll see you next time.